So today we want to focus back on the UK equities market. We've got a veteran fund manager, has 30 years of experience investing in this market, talking to us about 2022, how he picks stocks, and some great examples in his conversation with us. Let's go take a look. So welcome to Vantage. Delighted to have Richard Penny with us. We're focusing back on the UK equity market. Richard is at CRUX Asset Management. And you've been looking at UK equities for a long period of time. We'll come to talk about that. But before I really get into you and the fund, I have to ask you about your perspective on UK equities right now. It's been a sort of choppy market for the last couple of months. Love to hear your perspective about the outlook for equities and how you're positioning yourself.
Yeah, well, of course I'm going to say UK equities are cheap or lowly priced. But actually, I think they are lowly priced, and I think that should lead to outperformance now. A year ago, post-Brexit, or the decision on Brexit, we thought there might be a catalyst there. That there wasn't last year. I think growth stocks in the US were very strong last year. But I've looked at some research which suggests that since 2014, kind of around about when Brexit started to be a thing, the US is up 110%. The UK is only up 50%. Disappointing. But actually, if you do it on a like-for-like sector basis, half the gap is only explained for by the sectors. So the fact that we have more value stocks in the UK, the banks, the miners, the oils. I mean, there's lots of tech stocks in the US. So half of that difference is explained by that. So that's kind of some upside to go for. And the second factor is just very recently, the differential between the tech stocks and those value stocks, which is as stretched as it's ever been, has started coming in. So there's perhaps two reasons why the UK will not only be cheap and undervalued, but might actually outperform.
Yeah, it's timely because I'm sure you've seen the charts of the ARC ETF, crossover point with the value ETF, etc. And so now, if you've been investing in value, finally you're ahead. So I think that's sort of, and we can talk a little bit about the debate on value versus growth later on. Tell us a little bit about yourself and your journey effectively into fund management and what brought you into the sort of current role.
Yes, so this is my 30th year doing fund management professionally. I obviously did some research at the start, but and prior to that, actually, I was interested in investing in shares because of the government privatisation issues. So that got me interested initially, and then I started off in Scotland. Scottish Amicor, I've been to M&G, I was Legal & General for 15 years, and then I decided to live the entrepreneurial dream. So I now work for a company called CRUX, which is an established boutique. It's a nicely profitable company. We have 20 people, and it's a really good home. So we're long-term investors. The fund managers own the business, as do the other employers, of course. And it's a place to sort of stamp your identity on a fund, and the fund that we launched just over 3 years ago is the CRUX UK Special Situations Fund.
So CRUX is you describe it as a boutique. Tell me a little bit about the sort of culture of the place and the Special Opportunities Fund. I'd like to learn a little bit more about that as well.
Yeah. So the culture of the place, we are long-term investors. So boutique is a bit of a catch-all. There's hedge funds, there's short-term traders, there's people that do technicals. We're interested in fundamentals driving share prices. We think that alignment is really important. So we put our own money in the funds that we run, but also we look for that where we can in the business we invest in. So we like it when management own a lot of shares. A trigger can be also when they're adding to shares, they're putting more money in.
You launched the Special Situations Fund. I'd like to learn a little bit more about that as well. Yeah,
so its philosophy is that it's easier to make money in inefficient markets. So it's predominantly a small and mid-cap fund. It's for capital growth. We're looking to be the UK market by 5% per annum. We tend to invest behind change because the stock market, there's lots of very clever people investing in shares, and when you're buying them, they're selling it to you. But as a boutique, I found that often when you're investing behind change in a company, As a boutique, you can move quicker. You don't have to write a 100-page note.
Yeah.
You may well have built that knowledge up over many years. And we can add value there, so we can add alpha. So there's just things like recovery stocks, management change. It might be new product launches sometimes. It might be a company moving its listing from the UK to the US.
Okay.
And yeah, those kind of things.
Okay, and I was looking at the sort of January fact sheet, and the weightings of the portfolio. I mean, about a quarter in sort of large cap, over £5 billion market capitalisation companies. Then roughly about a half in that sort of 500 million to 5 billion range. So clearly a focus on the mid cap space. And then, a quarter in the sub 500 million. In that, I'd love to hear the story of, the different market constituents, what you hope they add to your portfolio, why you look at that range, and maybe sort of walk through some examples for the, large cap, mid cap, and small cap stocks that are in your portfolio.
So, I mean, it's a multi-cap fund. Philosophically, it's easier to add value sometimes in the micro caps, but they are more volatile. So we tend to position micro cap, small cap at 1% to 2%. The mid caps and the large caps, we get high conviction, but there are less of them. But we will invest at 3% to 5% in those.
Okay.
So it's kind of 25 stocks in large and mid. So between very, very big and 500 million.
Yeah.
And then kind of another 25 stocks roughly in the smaller caps, but smaller positions.
Yeah.
So if you look at a fact sheet, you will see some of the bigger names. So in large caps, special situation, Aviva. It's had a checkered past, but it was always some of the parts was more. So Aviva, the insurer, as opposed to software stock, there was always the sum of the parts, but it always kind of felt slightly like a value trap. They were always going to sell this or that. But the new chief exec came in. She put £1 million of her own money in, which I believe is meaningful.
Yeah.
And then we saw action. So she was selling the Singapore division, subsequently sold, Italy, France. And that means there's a lot of capital available potentially to give back to shareholders. And the shares have been good. And there's potentially up to £5 billion to give back now. So, potentially there's more upside. That's kind of a special sit type thing. AB Foods would be another one. There's a large stock where, it's Primark. Obviously, it's a special sit really because people are overly negative on what's going on with the Primark, which is physical retail and under COVID. But there's Twinings. There's quite a lot of steady businesses in there, and the sum of the parts is quite a lot more. So we think that that's mispriced. And then there's a variety of other sort of strategies that we'd use. We often back management teams along this alignment idea. So we did very well with an oil stock called Kistos. We continue to own it, continue to see upside. Andrew Austin from Rock Crows was a multi-bagger. Yeah. It was for me, previous place I worked. We've backed a lady called Vin Maria and a stock called ADVT, the queen of software, she's known as. She's been very well with 3 quoted businesses before. So that would be one of those. Sometimes I do technology crossover, whereas there's sometimes companies that are sort of under 300 or 400 million under the radar in the UK that have got technology that might be really, really highly valued if it was in the US. Now, the key to this often is for them to be well financed. Check that the management can actually deliver. It's not just a promise, but that's been certainly very good for me over the last 3 years. And with the sell-off in growth and technology, a couple there that I've gone back to. Well, we've done very well at a business called MaxCyte, but it's coming back into a buying level. It went from £1.20 to about £12 as it went to a Nasdaq float. Yeah. Back at 470 now, with 170 of cash. If the stock market chose tomorrow, you'd buy that. Might come lower, but I think those have the potential to double. And the other one where I think it's properly mispriced, a stock called FD.T.L, used to be First Derivatives. I've known it about 13 years. They've got a very good consulting business and a marketing services business, which are probably worth somewhere between £14 and £16 a share. The shares today would be about 16. But they've got a West Coast, an American software business, which potentially is game-changing. It's valued anything between 0 and 2 times sales. There is the potential to double those sales, and the valuations for those, should they ever get it listed in America, would be sort of 4 or 5 times what it is. So I I buy them today on a 3-year view. I'd be disappointed if it only doubles, but it could be quite a lot more than that.
So some very familiar names for us in that. I've also noticed from the strategy that you describe them as stealth compounders, and we've had a number of people sort of on the show talk about the power of compounding and just how important it is for performance. And occasionally, you step in and sort of pick things up from people who are forced to divest of businesses. So give us a couple of examples of those.
So a stealth compounder, it's a bit like the arbitrage with the technology crossover. What's in the UK under 500 million can be massively underpriced relative to US Nasdaq. With a stealth compounder, it's kind of similar, but in the UK. So a lot of investors will not invest under 500 million or 300 or 200 million.
Yeah.
So you can buy a compounder business with good return on capital and growth for a lesser price. Actually, it's a period probably when it can grow stronger, top line revenue growth, at a cheaper price. As it gets bigger, it comes onto the radar of more people, hence stealth below the radar. And you get a double whammy of growth in the business plus increase in valuation.
Yeah.
And then one that I particularly think of there is Inspecs, where it was floated in February of 2020, not necessarily a great time to float. And they've hit the numbers. They've bought a business really well called Eschenbach, a German business, UK business buying a German one, which is always good news. Plus a couple of other ones. It's not the cheapest stock, but it's just got that long-term demographic growth that should give many years of growth. Very high margins because they make eyewear, lenses, and frames, and there is the scope to consolidate that marketplace. So potentially it's more acquisitions. Management own 20% of it, so it's that's a sizable chunk of change. It's tens of millions of pounds, so they should be really good custodians of our money. And then sometimes buying off forced sellers. We did very well with IP Group, where there was a notified overhang of shares 2 or 3 years ago. Well, we kind of done that again with a business called TruFin. And the more recent one we've done there is a fund called Marwyn Value Investors, where we think the asset value is about £2, could grow to £2.50, £3 over 12 to 15 months under good circumstances. The share is about £1.18, and I think there's a 9p dividend as well. So, value and a bit of growth, pretty appealing.
And look, I mean, you've identified the names and the strategies. Let's get under a little bit of the sort of, the investment process. So something comes to your attention that potentially fits one of those strategies, or fits effectively one of the themes you're playing. What's the process in terms of getting to know the stock, getting comfort, the due diligence that you do?
So I mean, at the top of the hopper, the ideas coming in, we get hundreds of emails. Sometimes something flags up as something where it might be mispriced. So I'll do about 250 meetings a year. It's often with holdings that we've got. It might be an acquisition of something we already own, and quite often 20% of the deals might be a special situation insofar as there's a capital raise going on. It might be a refinancing, it might be an acquisition. There is a very legal wall crossing process goes on where we are notified as an organisation. But potentially you can buy shares, often at a discount, in something that might be an improved situation. And so the sort of things we look for business-wise, ideally we like growth and business franchise that gives you return on capital. I'm sure a lot of people say that. But valuation is also incredibly important. And, style-wise, I'm growth at a reasonable price, or value with a catalyst, which I suppose is a confluence of revenue growth and good valuation. A lot of big growth stocks have frankly been a bit overpriced for some time. So I'm not really growth or value. I like
I guess I mean we mentioned at the sort of start of the program, but there's space for different styles in the market, I think, and that there are going to be those people who have that skill set to appreciate an explosive business which is going to change the future and can pick that up. Lots of people don't have that skill set. And there's others who are just very good at understanding, value, and this is the right time to buy into business. We see those triggers where something will trade at a particular price to book multiple, and those entrants will come in because that's typically they've got a history of making money on that. It sounds like you're fairly agnostic about the sort of growth versus value sort of debate.
Yeah, I mean, I think it's growth is what's going on in business. And value is how the shares are priced.
Yeah.
Now, clearly, you pay more for a business that's growing, and you pay more for a business that's growing that's also got a high return on capital because it compounds at better rates. So you want, when everything's added up, for the shares to be mispriced. That's the most important thing. Yeah. But then after that, you'd rather own growth businesses than not, because you can buy a pound stock for 50p, but probably you have to sell it for 80p to the next person, and then you have to find something else. If you can, with something like an FD.T.L, where I believe there could be many years of upside, if the market gets into a little bit of a funk and its shares trade at 5-year low, a third of where they've been, that could be a great entry point into something that's got many years of upside. And to some extent, getting the market sell-off combined with a long-term growth stock is where you can find the really big winners.
Okay. You launched Special Sits now. It has a 3-year track record behind it. I think, was it October, November last year that you sort of got to that sort of...
Yeah, that was, yeah.
I'm just, as a fund manager, what does that mean for you? Both in terms of opportunity, but also the sort of challenges once you've bedded down that record.
Yeah, so... I would say it's 30 years in the industry. I have quite a long fund management track record, but most people want to see you in an organisation and just check that it wasn't somebody else that was buying all the stocks. So we've done reasonably well. We've invested predominantly in mid and small cap, and the performance has come from those. Yeah. And some people have gone, actually, this seems to be working. And once you get to 3 years, then there are people that look at it. So at 200 million. Actually, we start becoming more relevant to certain brokers who wouldn't pick up the phone before. To some extent, there might be some very small friends and family deals and sort of some of the things like Kistos where we'd put less money into it. Mm-hmm. But we're still so much smaller than a lot of the other special situations funds. So a reality is that funds that people invest in have been getting bigger. So even quite a few of the recognised players in the small cap are running £1 billion, and so they might have to invest 40 or 50 million pounds into investments for them to make a difference to their own funds, and we can invest 2 to 5 million in things still. I think people know that the fund is here and hopefully here to stay. Yeah. Whereas when you're sort of 5 or 10 million when you're starting, people just want to wait a while. Yeah, okay. So
the opportunity is it gives you longevity. I guess you're on the radar more things. You'll probably see more opportunities come to you as a result of that track record. Interesting point about the fact that actually small and mid-cap funds have been getting bigger. And we've been looking at, I think there has been a shift in sort of market structure. One is one of the drivers it has been liquidity. And in particular, I guess post-Woodford, everyone wanted to make sure that they were in reasonably sort of liquid positions. It's meant that actually when you're looking at median investment in the small and mid-cap space, over time that's sort of gone up. Is that a trend that you've seen? Is liquidity a concern for you as a fund manager in today's market?
It's something we're aware of. I mean, in the structure that we have, it's an ultra-liquid small and mid-cap fund, and so we have that 25% in large cap. Yeah. And sometimes they're just offsetting the biases that we've built in because we've got a lot of mid and small. But no, there's a lot of liquidity in it, and to some extent it's built in that post-Woodford era. Yeah. Often the real huge opportunities can be in the micro-cap. But if you just build a portfolio purely of those, it's a different risk-reward proposition to what we're offering. And you have to have a longer time frame. And when you're building the fund rightly, you'd have to put liquidity constraints on it, so people would be limited as to whether they put the money in or out, which we don't have.
You've got a AA MSCI ESG rating on the fund. Yeah. I was just curious. I mean, you talked about your investment process. What's on a similar kind of vein? When you look at a stock, what do you do from an ESG perspective?
Yeah, I mean, as part of the investment process, you're looking for companies that are growing. So I think we all know that a lot of the companies that are ESG pariahs may have, horrible liabilities sitting down the road, or they're in decline. I mean, some of the tobacco stocks, or even some of the oil stocks. So we're just incredibly aware of that, and you've got to price that. But I mean, I think for the last couple of years, some of the very big funds, sovereign wealth, etc., have been moving the money out, and the differential between, the kind of return on capital you might get from an oil stock and a renewable stock, you might get 20-odd% from a Shell or something like this, whereas it might be 2 or 3% from a renewables. At some point, that becomes too wide. So we score well on ESG. Our process obviously looks to avoid companies that would suffer from it investment-wise.
Yeah.
And we're looking for companies to be improving their sort of carbon scoring and diversity. So we do watch that, and it is possible to monitor it. But quite a lot of the data to date is still evolving, even in large companies, let alone in some of the smaller companies.
Yeah, okay. We get a lot of people who sort of look at the show just to learn for themselves in terms of, there's more people invest. Certainly over the last 24 months, you saw, more and more people actually investing directly into the market. Given your 30 years worth of experience, I guess I wanted to ask you the question of, what's the one piece of advice you might give to someone who's looking to invest in the market, and a suggestion of the one book that they ought to read.
Oh my goodness, right. So the one book, at the risk of being a bit sensational, is a book called 100 Baggers by Christopher, which is a go-to. I only discovered it 2 or 3 years ago. I think it's only been there for 2 or 3 years. And I try and read it every 6 months. It encourages you to buy, proper businesses with growth, return on capital, select them judiciously, and then try and hold on to them, in good and bad times. And my advice would be, I ran an internet fund in 2000, so I learned this not from reading a book, but slightly different ways, that you've always got to marry the prospects of the business from the valuation, because you might see something you think is brilliant, but if it's priced to be brilliant, then if you're wrong, then you're going to lose money. So why that's important to the minute is people are paying very high prices for some of these MEM stocks, the exponential growth type stocks in the US. And, it's possible, it's very intuitive to invest sort of with your heart, but you've got to check what you're paying for it. And if it's already baked into the price, that can be quite dangerous, particularly when we're in the growth value debate.
There you go. You see a good value investor talking to you there. That has been fantastic. That's a good run through of the fund. We've learned a lot about yourself and your approach. I wish you a good 2022, and let's see how the year progresses. Richard Penny, thank you very much for coming on Vantage.
Thank you very much.
Pleasure.